Hi, my name is Ronit, and with Gaurav, we are the hosts of FinTech and Web3 Founders. Thanks to CFTE for producing this podcast. Our guest speakers, zooming in, I think from London, they're going to confirm that in a second, are Mahmood and Oliver. Hey, guys.
Hey, how are you?
Hey, pleasure, guys.
Did I get that right? Are you from London? Are you zooming in from London?
We are from the epicenter of fintech here in Shoreditch.
Oh,
And great coffee as well.
Yes.
Don't forget the great coffee.
Mahmood, Oliver, maybe a few words of introduction about yourselves to kick us off. Mahmood, tell us a bit about your journey in the world of investing. How did you get into this exciting, high-octane world?
Well, long journey. So in the early 90s, when I came out of university in London, what every fine thrusting young man wanted to do was get into investment banking. So I joined Morgan Stanley as an analyst, ended up spending the next 12 years on the trading side, then just got seduced by the idea of pitting my wits against the global financial markets and became a macro portfolio manager at some very large hedge funds. And then after the financial crisis, it dawned on me that if you looked at the sheer amount of data that was being produced about what was going on in the world, if you added to that the complexity of markets, information now travels at the speed of the internet. Asset classes are all interconnected. Something happens in the world of credit, FX suddenly moves. So you have complexity. And at the same time, processing power had become so cheap. So it seemed there was an opportunity to really apply what we broadly now call AI to basically gathering data and drawing insight from all that data, or as we sometimes put it, extracting signal from noise. And so at that point, I started a company called Quant Insight that gathers vast amounts of data and distills that, analyzes that using machine learning and so-called AI, and delivers insight to institutional and now retail investors as well.
We're going to come back and get into the whole area of AI and ML in a second, but I want Oliver to share his background a little bit, professional background. Tell us about yourself, Oliver.
Yeah, my professional background, I am less of an esteemed investor than Mahmood, but I actually started my investing journey right at the back end, or the infancy of the last recession, 2008. I watched a Warren Buffett documentary. I was a drummer at the time. I thought, I knew all the answers, and I started investing with my student loan. And inadvertently, things went up. And that sent me down a path of getting riskier. I went down the world of forums. It was interactive investor. I was looking at penny stock, email subscriber lists. So I've been a retail investor for some time, but in a professional capacity, I've run marketing businesses. So previously ran a business that we took public in 2019. And more recently, 2 years ago, about a year and a half ago, we set up a company called Flight Story. And one of our primary services is helping companies communicate better and connect with retail investors.
Thank you for that. Mahmood, what does AI change when it comes to investing, or let's call it AI ML? What does it change? Why did you feel the need to adopt some of these techniques compared to the good old-fashioned, I don't know, looking at accounts, looking at screens and charts and just saying, hey, I think this is going up. I've got a hunch.
Yeah, absolutely. I mean, we sort of have now, well, we are in the process of shifting from this older paradigm, which was about curation. It was about instinct. It was about basically the primacy of human judgment and a sense that kind of the human brain could deal with the complexity, bring in intuition. Our brains are sort of Bayesian inference engines. We connect all the dots and come up with a thesis or a hypothesis. And that is really shifting. And what's doing it is simply that there is too much information. And if you speak to any type of investor, whether it's retail investors, institutional investors, it really has become like drinking from a fire hose. And what machines do really well is gather vast amounts of information. They can parallel process what's going on with economic growth, inflation, what the Fed is priced to do, what energy prices are doing, which way the dollar's moving, and find these deep underlying relationships in the data. And if you're looking at your Bloomberg screen with, 1,000 little numbers flickering away in front of you in real time, I think we sort of realize that, well, the human brain cannot parallel process all this and figure out underneath those 1,000 flicking numbers, what's really going on. This is exactly what computers are good for. Now, what's interesting is that a lot of the machine learning techniques and even neural networks are not new. In fact, a lot of these techniques have been around 100 years plus. What's new is that processing power has become so cheap that we can now actually harness these techniques in a cost-effective way. And so it seemed to us that where we can help investors is you still need judgment. The question is, what are you applying the judgment to? And for us, the advantage now is you can apply your judgment to evidence, data-driven hard evidence. And we're in the position where we can distill this vast amount of data into a small set of hard evidence. And investors now use that hard evidence and still apply their judgment, still look at various dimensions of investing. But the overall impact is it's helping them make better decisions.
Can I just pick up on a couple of things you said there, Mahmood? You said machines are better at doing a lot of things when it comes to quantity of data and also looking at relationships. And in this new world that we're sort of gently getting into, cautiously, nervously going into, what's the relationship of human versus machine or human versus algorithm when it comes to investing? What do we need the human for? Is it just an emotional relic that we just want the named fund manager there, or what do we need the human for?
No, I don't think it is a named relic. And I also think we tend to think of human versus machine, and that's actually misleading because what we're talking about is human and machine.
Yep.
And actually, there's a great quote from Paul Tudor Jones, I think, from a few years back, is that something along the lines of nothing is as powerful as the combination of a human and a machine. So these are really complementary. Now, there's some things that machines really cannot quantify. So one of them, for example, is geopolitical risk. The machine may analyze all the data and tell you that crude oil prices, given all the supply information and all the global growth information and the inflation information, is too expensive. But if you see an announcement that OPEC has just decided to cut production, or one country's just decided to invade another country, or war has broken out, you need the human to really understand what that means in the context of kind of crude oil prices. And so we even see this in systematic algo-driven funds that actually have in their prospectuses what is sometimes called the big red button, where the human comes along and says markets are no longer functioning and therefore we're liquidating, and the human hand will hit the red button and liquidate that fund that is 99.99% of the time purely, totally computer-driven, algorithmic, and systematic. So there is plenty of role still for the human, but I think what investors need to acknowledge and appreciate rather is that it's not a competition. This is here to help and actually enhance the human skills, not replace them at this stage.
And so again, if you get a bit more specific or granular, what bits of the investing process that, say, we had in the 1990s when both you and I were in the investing world, or in the 2000s pre-financial crisis, what bit gets replaced or enhanced on the buy side? Or in terms of giving sell-side analysis, what bits get replaced?
Well,
Or enhanced? Enhanced is a better way to think about it, not replaced.
yeah, I think that a lot of the kind of bog standard kind of, Excel based correlation chart based analytics. So you're sitting there on the desk and, there's an announcement, about crude oil, for example, and you're on the FX desk and you'll look at the analyst and say, well, if crude oil goes up $10, what do we think happens to the ruble?
Yeah.
And they'll go and run their kind of correlation analysis. And you'll get your scatter plot of the last 5 years, dollar ruble versus crude oil. And an hour later, we'll be looking at it and kind of trying to figure out what it means. What you can do now is just get an instant answer to that question, and you don't need that analyst to go and run that correlation. So, I mean, this idea isn't fully formed, but it's a bit like ChatGPT, but
I was just thinking that while you were talking.
For numbers rather than language, right?
Yeah.
So it all these relationships, you have machines now that are tracking all these things in real time, and you get an instant answer. So they are replacing some of those analyst functions.
Yes.
That's one kind of very clear, I think, impact that is coming from all of this.
No, absolutely, because there would have been fund managers like our common friend Krish who'd be calling me and saying, rates are going up. What does that mean for bank stocks? And then someone would just run a stupid correlation, a very, very vanilla correlation, and goes, rates are going up. That's good for bank stocks. Or
right, exactly. And now you actually can take all the data holistically, all the correlations between rates and other things into account, and in a nanosecond get a quantified answer that, if rates go up 50 basis points, all other things equal, pure impact of that on bank stocks, on the bank stock index, it should be up 3%. And so the human is armed with that in a nanosecond, and then they can add their quantitative overlay. Speed is really enhanced now.
And I guess then you're debating over the inputs, as in, are rates going up? When are rates going up?
Exactly.
Like now, do we have one more rate hike, two more rate hikes? When does the rate cut come in the US? I don't know. What you guys say? Actually, you shouldn't say that. Actually, that's probably investment advice. So don't say that. But those kind of questions, I guess we can.
I think the other thing that's changed, you mentioned the 90s, and what really strikes me is that, in the early 90s, if I went to the treasury trader, big investment bank sitting there on the dealing floor, and I asked them right now, where's the S&P 500? They may or may not know, actually. The equity world and the rates world were so siloed. Credit didn't even exist. And one of the big changes is that now all asset classes trade off each other so actively. Something happens to the commodity complex, something happens to China, something happens to credit, something happens to rates, impacts equity. Something happens to bank stocks, impacts rates. So I think the level of complexity and interconnectedness has changed quite dramatically in the last 15 to 20 years.
Yeah, because the amount of information that there is, I mean, in a way, we don't want to just call what you're doing the ChatGPT of numbers or investing, but you're replacing or enhancing Excel that we all grew up with. But my first boss in the city didn't even use Excel.
Yeah, what was it? Lotus 123. Yes, I'm that old.
Yeah, but he didn't even use that much either.
Right.
He would basically do his hand.
Yeah.
He'd have a calculator. He started work in the 60s.
Right.
He was really old, and I'm also old now, I guess, but he was really old back then. And I would go into his office on a Monday morning, and he'd have his financial model on a spreadsheet. So not a spreadsheet, on a piece of paper like this. Because he began working, I think, in the 60s. Just as these spreadsheets were taking off. But he knew, because he'd been in the business 25 years when I was his graduate. He knew what would happen if rates goes up, right? Because he had 25 years experience. So that was his gut instinct. And then anyway, he took all of this and he created Quant Insight, which was for institutions. And then at some point in the last year or two, you said, hey, there's this other big mega trend, the rise of retail. the rise of the retail investor. So let's offer something for the retail investor. Talk us through that journey, and then we'll bring Oliver in. So talk
Yeah,
about
absolutely.
which is a really cool name, if I can say that.
Say again, sorry?
I said IQ is a really cool name because, you know, you're playing with QI, you're playing with, you know, the I,
Yeah.
intelligence, and all kinds of cool
All
things.
that stuff.
Who
Yeah.
came up with that name, but whoever did, it's a cool name.
Thank you. So this was really interesting because, you know, as an entrepreneur, you're always kind of thinking about the big problem to solve out there in the world.
Mm.
And it became very clear with the Robinhood phenomenon that there was this absolute surge of interest from millennials and younger in trading. Now, I couldn't understand why an 18-year-old was interested in what Jerome Powell was going to say next, but the fact is they all are these days. Well, a lot of them anyway. And what really moved the needle for me was when I realized the percentage of retail traders that lose money.
Mm.
And it varies from 65 to 90%. The average life of the average retail trading account from when they put their deposit, you know, my £2,000 deposit or whatever it is about 6 months until it hits zero balance. So we looked at this and said, oh my God, this is bad. These guys are just getting completely, you know, ruined. It's just disastrous. And at the same time, we were sitting there on this kind of institutionally focused, high-end, quite sophisticated, powerful set of analytics that helps you understand what's going on and helps you make better trading decisions. And for us, the leap to say, well, surely we should simplify this and add more narrative around it, make it really accessible, and take it to the retail trading world. And of course, we ran the numbers, and about 8 years ago, there were around 250 million online trading accounts. And today there are about 450 million online trading accounts. I mean, India has 45 million. This is 2 years old, this data, online traders. You know, the top 4 in the US have over 100 million accounts. I mean, it's just exploding. And so we just thought, well, we have things we can do to help retail traders on their journey and significantly reduce their loss rates. There's a massive growth in the number of them. There's a huge hunger for better information. And there's also a sense amongst the retail investing community that they're sort of cut out from the good stuff. And so we thought, well, this is a great opportunity to actually take this word you hear all the time, democratization, and actually, you know, implement it and do something about it. And so, yeah, that's how we thought, okay, we have to do this.
How did you get to know this fine young gentleman, Oliver? Like, what does he have to do with this?
Well, it was interesting because Oliver works very closely with a gentleman called Stephen Bartlett. And Stephen Bartlett, very high profile, you know, hosts Europe's biggest podcast, The Diary of a CEO. And a lady who runs our communications, Ilana, had met Stephen several years ago at a conference in London. And we were talking about, well, how do we get this retail message out there? She said, well, you have to get in touch with, you know, this company. They virtually invented modern social media marketing. They're amazing. And she told me all about Stephen Bartlett, and I went to look him up, and I was like, wow, yes, amazing. Company that he created was called Social Chain, and Oliver will tell you more about that and how he met Stephen, I guess. And so that really got us down the road to meeting Flight Story. And we really approached them just as they were starting, and Stephen was co-founding with Oliver Flight Story. And so I guess we were one of their early clients.
Segue to Oliver. So Oliver, tell us about IQ from your side. So before we get into that, just maybe give a bit of context about the world of social media and how you use that and how you're going to help our friends at IQ, QI reach a zillion retail clients through this.
Yeah, as Mahmood mentioned, and I'll go into our first interaction because I went away, felt like I'd just earned my MBA in investing. as a naive retail investor, but we'd spent almost a decade supporting some of the world's biggest businesses. And fundamentally, the role of my career has been helping companies understand social media and apply it to help them serve their business goals. And we've done this for Amazon, Apple, Disney, the who's who, you name it. We've worked with probably every sector, every company. And then about 2 years ago, Stephen and I left that business and decided we would start something new. And a good place to start is reflecting and going, what were we good at? And a starting place where we are really good at helping build the teams and philosophies to help companies speak the internet more fluently. And why is that important? And we'll probably go into that. And the second part
was... Explain that term, speak the internet, please.
Yeah, speak the internet. Look, the internet can be a weird, wonderful, fascinating place, right? And I think when I think of these tectonic shifts throughout the last several decades, the internet was certainly one of them. Following the internet, and the way we look at the internet was the digitization of information, the ability to take information and create a dialogue online. That enabled things that we know today like commerce. You know, that started to then evolve alongside the development of mobile. So you see the internet, which enabled things like social media. And social media, again, was one of those big tectonic catalyst moments that shifted a lot of things, right? When we talk about democratization, social media is at the heart of that. This ability where individuals can come together and collectively have true influence and true power. We see time and time again. So it affects our politics, our culture, it affects industry. And then what we started to notice is in the financial sector. So our background, we'd serviced a lot of chip industry. We were being asked at the time, the context of the world was, there was a moment where Reddit and GameStop was hitting headlines. For those that aren't aware, Reddit and GameStop, the GameStop moment was a bunch of Redditors charged by a guy called Roaring Kitty that was an ex-banker, had banded together and did this really technical, interesting analysis of why he believed GameStop was underpriced, right? And a lot of it was to do with the institutional games, and he rallied the internet. He rallied the internet to get behind GameStop. And basically, over the course of about 3 months, we talked a lot about information, logic, illogical things started to happen. So what basically happened in that moment was people came together, communities came together and drove the stock price over 40x. It went from around a $300 million market cap to about 40 billion. The space of 3 months. Obviously, these aren't logical decisions. As a consequence, all the short sellers started to obviously not be able to defend their position, and it caused a few famous hedge funds to disappear. As a consequence of that, as you can imagine, the industry starts to say, well, what does this mean for us? And if you're a public company, if you work in the sector, you should pay attention. So that's where we came in as people that understood the internet, understood the dynamics of community, and felt, okay, well, we have this skill, this thing we're good at. How can we help and apply it in a new way to great effect? And we started to consult for public companies, and we very much helped them get IPO ready. They now have a burden to communicate with investors on a very frequent basis. And this led us down the wormhole of understanding the retail investor. And we talk there and trivialize it, but the retail investor to me is, you know, you're a retail investor, Mahmood's a retail investor, as much as you're highly skilled. It's not just the young, impressionable degen that decides they want to, you know, put a middle finger to the system. It's a very broad spectrum. So that's where we connected. And since then, we've been looking at building a product and taking all this information and this institutional grade toolkit and saying, how can we give this to retail investors to level the playing field? Big mission, and that's what inspired with Mahmood when he spoke so eloquently about the mission and the injustice that exists and the motives. I was blown away, and we wanted to come along the journey.
I want to unpack a little bit more about the whole democratizing of finance, the retail side, and also using social media, whether it's in the investing world or other areas, other domains. But I want maybe Gaurav to jump in and sort of pull at some of those threads a bit better than I will be able to do. So Gaurav, over to you.
Thank you so much. There's so much to unpack here. On one side, you've got social interaction and engagement, and on the other side, you've got AI, which has nothing to do with the human elements. You've got the human element with the computing element. It's a very deadly combo if you get that balance and ratio, right? So you guys are a double threat. I thought Ronit and I were a double threat. I think you guys are the real double threat here. But jokes aside, none of this happens overnight, guys. So this is something that we do on this podcast is we want you to tell your story. It's not like you woke up, you switched on a light, and hey ho, there you go. Your business is where it's at today, right? It's been an evolution, it's been a journey, and there's an element of surprise along your journey, I'm sure. And so I want to dig on that just a little bit quickly before I start tearing into product, because that's going to lead me into product, because that's your journey, right? So but first thing is you start building and you go to market, right? Mahmood, from your side, you start going to market and looking for customers. Who were the first early adopters? Were there people who you knew who trusted you and said, I want to back you? Or was it people you didn't know, but they were so convinced by the elements of what you're doing, they said, we have to have it? Tell us about that a little bit.
Yeah, well, I started off thinking, right, we're going to take our analytics, covers 10,000 stocks and futures and indices, the whole thing. And we're going to boil that down into a nice little visual that gives you the odds of this stock going up or down and the elements, that are driving that piece of analysis. And what Oliver really brought to my attention, and I realized he was right the second he said it, was that, look, you're asking people to play a new game. Why don't you actually win the game that's actually being played? That's a far safer business decision. And what he meant was that, look, there is no real evidence here that if you go with an AI analytics toolbox, anyone is going to give a damn about that at all. Do know is that great content and great narratives work. And you can
storytelling.
Storytelling. Absolutely. And so you can look at Substack and the number of newsletters out there, 600, 700,000 subscribers, whatever it is. You can look at subscriptions to the Wall Street Journal or the FT. All this stuff has been going up a lot in recent years. And so what the big initial lesson for me is that, your AI stuff is unique, but it is where you end, not where you start. The place you start is, okay, we've got a signal that says buy Barclays Bank. Right. We're going to start with the story. We're going to talk about Barclays. We're going to bring in the earnings. We're going to bring in the sort of things that Barclays should care about, interest rates going up, what the Bank of England said. And at the end, we're going to say, right, what is the trade then? Well, as it happens, the machine is giving us a probabilistic lean, and we can bring in other elements too. And that narrative, the whole story, is compelling, and you've used your special ingredient in there, but you're not leading with the special ingredient, because we don't know if people just want a bag of salt, but they want food that has some salt in it. And so that for me was initial. And I've been around long enough to know in business that what I might think is a great idea sitting there in the bath might actually really suck. And the last thing you want to do is go and start hiring developers and building this product and have no real idea whether people want it. And so that was stage one. And stage two is that we built a community on Discord, and we've been going a couple of months now. It's organic growth. It's got about 700 members there. And it's a very broad mix. There's some very seasoned ex-hedge fund managers. There's young people just looking to learn. There's the other thing that we're adding is a strong educational element.
Very B2C, right?
It's very B2C. And the other thing that I learned was it's not about the product for now. It's actually about building the community. Mm-hmm. And you want a community that delivers value, and you want to give, and grow that community. And then down the road, you can figure out how you monetize that community. So those are
very much like Titan as a story, right?
Titan.
Yeah, very much like Titan. Titan's also trying to get a story out there a little bit. They're trying to educate people a bit more, right?
Right. And I think we've got a very strong narrative, which is, the whole, retail investors don't have access. I mean, the core narrative is that we know that in investing, as in life, outcomes will vary. Some people will be more successful in investing than other people. That's just a fact, and it's never going to change. The problem is when the outcome varies because some people have access to information and other people don't have access to information. That's the problem. Mm-hmm. And so our role is to give everyone access to the highest quality information. And then the chips fall where they fall, but at least they've all got the same shot. And the problem, especially if you're a retail investor, is that, I'm not sitting at a big hedge fund. I don't have access to anything. And that's not fair. So I'll pay for it, but make it reasonable and give me access. And there's hundreds of millions of us. And nobody's really going to them with any quality. So that's kind of the approach. But hopefully I answered your question of at least two surprises for me that I learned on the road.
And I think just to add to that, what was really interesting with Mahmood, I was blown away by what they had built. And actually the way that the product's able to articulate very complex subject matter. But my advice was, you happen to have a product, but you should be a content business first. When you're particularly, and I'll speak anecdotally, and I'm sure we can all be familiar. Several years, probably 2 or 3 years ago, I just started to notice in my group chats that we would speak about investing in the same way we would sport, in the same way we would music. Investing became a passion for people that aren't in the sector. These are people, some entrepreneurs. One of my friends who is a bricklayer, he used the word yield curve inversion. And he's a bricklayer. So it's these where I go, okay, well, there is something happening here that is different to the past. And fundamentally, investing for me, when you get under the hood, is as much psychological as it is logical, right?
He wasn't a retired hedge fund manager, just like
he wanted a simpler life. He wasn't actually.
Do something with his hands.
He was doing some work on his conservatory.
Yeah.
I had my personal trainer last weekend talk about de-dollarization, and I was like, no.
Wow, it's just getting out of hand now.
It is. It's just getting silly.
It's symbolic, and if you want to connect with retail, you have to understand the dynamics that retail care about. We care about news. Retail cares to win. We care to show off. We care to have the secrets. And actually, what Mahmood and the team are doing is doing that with a degree of sophistication. So it was about just re-engineering the sequencing of events of what is the foundation of the company. The secret sauce is the machine learning, but how you bring that to life in a way that's incredibly compelling, that's the point of difference for IQ.
Exactly. It's how we bring it to life is through content and narrative. That for me.
Let's bring this together, right? Because these are two elements which you're again, we're merging these elements, right? So on one hand, you're building product, and on the other hand, you're building stories, right? For people to consume. So tell me about, what does your product roadmap look like from an AI perspective on data? How do you build product and then keep evolving that build product, especially with the nuances of how volatile the markets are today and how trends are really chopping all over the place, right? There's no historical back markers which can explain what's happening really in the last 3 years with COVID or with, as we say, wars breaking out or anything else that happens. So how do you, first of all, build your product pipeline from a data build? And then if you can explain to us how you're monetizing that, that's great to understand, because you've got to build to return money.
Yeah. So step one, as I mentioned, is the community, and what we have on Discord is various pretty experienced investors writing very accessible content. A lot of that is around a particular signal that the machine has generated. So there was one recently, I think it was Barclays. And what the machine does is essentially it looks at all the different things that should impact Barclays: interest rates, the yield curve, economic growth, inflation expectations, all this stuff. And it basically understands the relationship between Barclays and all these variables, and was basically saying, look, given the relationship Barclays has to all these variables, And given where they are now, it's 10% below where it should be. And so you get this nice little visual, and then a little bit of educational stuff around why do banks care about the yield curve? Because they borrow short, they lend long, they get a yield pickup, it helps their margin. Economic growth impacts default rates and loan losses. And so you have some educational stuff going on. And the people in the community ask questions about it, and we have an interactive dialogue, and that's all great. Now, where does the product roadmap go? One of the bits of feedback we had in the last month was that, okay, they see the signal and they see the debate, but they kind of are asking, okay, what next? I need some other information. And so the next step of the product roadmap is when they click on that signal in Discord, they will be taken to an external web page. And that external web page is going to have a tear sheet. And that tear sheet is going to be everything we think you could want to know about Barclays. So it's not only got the actual price versus where the machine thinks it will be. So 2 lines that show you kind of why the machine is saying you should buy it. It's also going to tell you the key things you need to watch out for: interest rates, inflation, the top 3 things you need to watch out for that impacts Barclays. We're then going to bring in the fundamentals. And so you're going to get Barclays P/E ratio, you're going to get the sector P/E ratio, you're going to get the index P/E ratio, you're going to get the regional P/E ratio, you're going to get the price to book. So you're going to get those 4 things. We then also realized that one thing that retail investors really struggle with is understanding the riskiness of what they're doing. And, they might sit there and say, oh, wow, natural gas has gone down so much. But what they don't appreciate is natural gas can move 50% in a week. It's so volatile. And so, in fact, wheat, natural gas, all these super volatile, whereas a small utility stock, much less volatile. So we're going to create a risk score. And that's also going to have some practical information like, what's the biggest percentage change Barclays has had in any given month over the last 5 years? Just an order of magnitude. Give me a sense for how spicy is this thing? Is it a Vindaloo, or am I just talking about, something? And we're even toying with the idea of 1 to 5 little chilies.
I feel like we've gone on to Gordon Ramsay's cooking show suddenly.
Yeah, exactly. So there's going to be a risk part. There's also going to be a sentiment part. So we've got a lot of sentiment scores. There's going to be analyst rankings. How do the analysts rank Barclays? What's the percentage of buy, neutral, sell recommendations? There's going to be top news. What do I need to know about, what's been the big news headlines for Barclays in the last 3 months?
So much information curation.
A lot of, and putting it all together. And then finally, there's going to be the 1 paragraph description of Barclays. So that tear sheet, once you get there, basically has everything. And we're also toying with the idea of scoring each one of those. So on fundamentals, it scores 6 out of 10. On macro, it scores 8 out of 10. On sentiment, it scores 2 out of 10. And so the idea is you then go to this tear sheet, and you don't have to go anywhere. You don't have to go to Yahoo Finance. You don't have to go to Bloomberg. You don't have to go to ChatGPT. You've got everything. And the way we monetize, this is the current thinking, is that this flow is the 1 to 3 signals a day that will be discussed on the Discord platform. But the natural question for many investors will hopefully be, well, this is great. This is everything I need to know about Barclays in one place. I mean, everything, every angle, every dimension. But I got 10 other stocks I want to find this out about. Okay, then you subscribe. And, that's when you have the paid product. And then the further part of the roadmap is adding it to your portfolio, actually having clients and users track their portfolio, providing for the first time risk analytics on the entire portfolio, which nobody seems to be doing for retail. You go to a retail broker, they don't tell you, on average, a sort of simplified version of value at risk. On average, what percentage change would you see in a day for your portfolio? If it's full of risky stuff, could be 3% is no big deal. If it's non-risky stuff, a 3% change should be very unusual. Nobody's giving them that simple risk framework. And we've already done this, we also believe a big trend is people are interested in thematic investing. So electric vehicles, women in
ESG,
ESG, all sorts of things. AI, metaverse, generative AI. So we've created like 20, 25 thematic baskets. There'll be a whole thematic section. And so that's our sense for the roadmap.
And sorry, please, Oliver.
Yeah, and I was going to say, one of the things that's phenomenal about what's being built is it taps into the psyche of retail. You know, one of the big underpinnings that is driving momentum and interest is this ability, these community dynamics. One of my friends once said to me, and it was a real light bulb moment. He said, in the institutional world, if I have the winning strategy, I'm not shouting it from the rooftops. If I have a winning strategy in my Reddit forum, my Discord, my Telegram, I am telling the world. I want that validated. I want to share and celebrate that.
Such a difference.
And that's a huge difference. So by giving the tools to retail, it really creates these network effects for people to celebrate and be the smartest person in their room. And that's where the intersection between a product and the ability to self-promote through the community itself. So on one hand, the community gets a ton of value for free. And if they decide that this is a tool that they want to use to aid their investing efforts, it's great. But if not, they're still going to get a lot of value, and it's self-fulfilling in terms of the promotional aspects of any product.
Okay, I'm going to ask you guys some questions for our audience. Feel free to answer them or not, depending on privacy, right? So how many years have you been building for?
So we've been around 7 years now.
And how many users do you have right now?
So on the institutional side, we've got over 50 firms. And of course, on the retail side, it's just a free community, and we've got around 700 Discord members. We've been going a couple of months.
And for your institutional, I imagine that product build and that engagement from an engagement model is private. That's not
Yes.
That's public information about how you're engaging institutions on the monetization piece for your services.
Yeah,
but
so
on
for the
public
institutions, you know, we charge anywhere from $15,000 per annum to $100,000 per annum. So institutional products. What I can tell you is, if you add all our institutions up in combination, they manage about 7 trillion of assets.
Oh, wow. So and how much are they leveraging your technology and services to actually, what percentage of that 7 trillion is attributed into your
significantly? And, you know, we sort of made some headlines last summer. We announced a collaboration with Goldman Sachs. They are a distribution partner for QI. So alongside MSCI, Axioma.
Wow.
With a fourth partner that Goldman Sachs have taken on board. So Goldman Sachs global clients can get our analytics via Goldman Sachs Direct now.
Wow.
For subscription, of course. So, you know, we found that we've seen a significant acceleration in the last couple of years.
And on the consumer side, the retail side?
No paying customers at the moment, just build the community, give value, grow it. And towards the end of the year, we want to then start thinking about releasing the paid version,
which will be sort of monthly or annual subscription.
Yeah, monthly.
And then you'll have other services and pieces to it as they want to. I think want to get deeper into the information that you're providing, right? Or how they want to use that information.
Yeah, I mean the general price of this stuff is, you know, $15 a month, $20 a month, something like that.
Wow. So that's very, very interesting. So essentially what you're doing is what you build for institutions, you're now looking to provide a miniaturized version of that to consumers, essentially, who want to play it, right? And so that's 7 years in the making today. Yep. Now, you know, with what we've been talking about, building product, building community, building the technology, which, you know, generates signals. What does the next 2-3 years look like? Does it look like more institutions first before consumers come in, or does it look like acquiring platforms that already have ready-made users that can take advantage of what you have and accelerating that, or partnering? What do you both foresee as the next chapter that's coming?
I mean, the debate I have in my head and with the senior management team is we've got real traction on the institutional side. We need to capitalize on that. You know, revenue's doubled in 9 months. We just need to keep going on that. And that is really the anchor, high quality earnings, very low churn. You know, we're selling via API. Once we're in, we're in. And we don't want to take our eye off that.
Mm.
So out of our 30 people, we've probably got 23 on the institutional side, 7 on the retail side. But at the same time, we realize with retail, sooner you start building your community, the better. And so, you know, they may well become 2 separate companies. We're not sure yet. But we want to do as much as we can in retail, subject to the constraint of making sure we capitalize on the momentum we have on the institutional side. So that's sort of how we're thinking about it.
It's super interesting, you know, when you talk about a number like 7 trillion, if I heard you correctly. I'm just going to clean my ears again one more time. How much upside is there for you to grow in that space from a management perspective? So 7 trillion, it's from your customer portfolio effectively, to which you're saying a significant portion is interacting or dependent on your technology and AI and insights and signals for them to operate. How much more to go? What market share is that?
There's plenty more to go. I mean, there's 115 trillion in institutional, you know, asset management globally. So there's plenty more to go. And you know, there are something like 6,000 equity long short funds in the New York and Boston area. I mean, we're just scratching the surface.
So let's close on one chapter before I hand back to Ronit, which is competition, right? You know, we have a lot of people hungry into this space. I don't know how many obscene billions ChatGPT got from Microsoft. I think it was 10 or something. I can't remember. Ronit will correct me on data because he knows the numbers on the tips of his fingers. But the space is definitely attracting people. You may be ahead, or you may have peers who are close to you or ahead of you in some space. How big is the space in terms of people participating, not necessarily exactly in what you're doing, but perhaps in a similar space, which are working with the same target audience that you're trying to do from the institution level, at least?
Yeah, on the institutional level, there's various, you know, areas where we see competition. There's the incumbents, you know, the firms that are huge in analytics, whether it's MSCI Barra or Axioma or S&P Global or Refinitiv or Bloomberg. And, you know, we saw Bloomberg GPT announced not so long ago. And so there's undoubtedly competition from there. In terms of our specific little niche, the good news is we don't really see competition. The bad news is we don't really see competition.
Yeah, so then you're not educating the market fast enough for an uptake.
Oh, yeah, exactly. So, you know, but through partnerships, and there's another major partnership coming very shortly for us, S&P 500 quoted company, multiple billion, well, 2 billion revenue. So we're doing a lot of partnerships, and our sales approach is to leverage partnerships. And I do find in the institutional world, 10 years ago, everyone wanted to build, right? They just, you go and speak to a big sell side and they were like, yeah, we can do this ourselves. And 10 years later, of course, they hadn't done it themselves. Nowadays, they're much more open to partnerships and collaboration. There seems to be a new culture out there of partnerships and collaboration.
You know what it is, honestly speaking? I'm a product guy, right? And I'm B2B myself for the last 20 years. Honestly speaking, it's the cycle of management in these institutions that results in the adoption strategy. If management change typically happens anywhere between a 2 and 3 year cycle, you will find your sales process extremely hard unless you catch them at the start of their cycle where they're trying to create an impact against their management and bonuses. But if you have people who are there for a minimum of 5 years, the frustration they have with the existing mechanisms makes them give up to understand that they can't do it themselves. So if you target the institutions that are 5 years or older with management cycles, you will find they will be the fastest adopters, other than those who actually have management cycle changes of 3 years and less.
Interesting. Very interesting.
I promise you, you run that data, it'll be a fact. and on that little note, a nugget of wisdom from my side of what I can contribute to AI from my non-AI brain. Ronit, back to you. Thank you guys so much. Super interesting. Super excited to see what you guys are doing more and learn myself from the community. I'd love to sign up and see what.
Great. I will send you the Discord link afterwards.
Super cool. Thanks. Ronit, back to you, brother.
Maybe just two questions to wrap up. One to Oliver, one to Mahmood. Oliver, how sustainable do you think this retail investing trend is going to be? As in, why was it just not a kind of zero interest rate flash in the pan? Is there something deeper into the society, culture? I mean, you can't turn TikTok on without seeing some financial or economic, and or maybe that's just the stuff that gets targeted at me. I don't know, but
That's your
it's
digital
like
reality.
what,
Your algorithm serves you.
what's like? Why is this going to not be just a flash in the pan?
Yeah, I think there's a couple of things. I lived in the US for a few years, for about 5 years, and knowing the US's relationship with finance, they don't necessarily have the social security blankets that I had growing up in the UK. So you can't turn on a news channel without a stock ticker. You can't go anywhere in a cab without seeing something about the economy.
Right.
401k, everything about that system is tuning people to make better, more informed financial decisions. And now, because of social media, culture spreads across the world. So the most dominant culture tends to dominate every single country. In the UK, we're more conservative, but you're seeing a huge rise in younger people that not just think about their pensions, they think about a whole range of asset classes. We haven't even touched on crypto, but you know, that's another conversation maybe for another day. But I think if you look at all the trends, you look at probably the biggest movement is going to be the generational wealth transfer that will occur in the next 20 years to people that are highly digital native. This is not a flash in the pan. This is a consistent trend that I only believe will accelerate. And to the question earlier about AI with Mahmood, we were talking about working in a niche. I think with AI being such a tectonic shift across many industries and the real world application of AI, I think it just lends itself to normalizing behavior. 2 years ago, launching an AI-powered tool wouldn't light the world on fire. You do that today and behaviors have been normalized. So I think tailwinds for a product like IQ, and I think the retail movement isn't showing any signs of slowing down. I think some retail investors are poorer right now. But beyond that, I think
that's just mean, Oliver. And I'm laughing. Not good. Not good. We're all horrible people.
Last question is for Mahmood. Mahmood, given everything you've learned and experienced and been through in the last 7, 8 years, if you had to do it all over again, and you're sitting there, that decision is there, what would you say to your wife? Honey, let's just travel the world, let's find a beach, or I'm going to do this again. What would you?
Well, I think part of me would be like, oh God, yeah, let's just travel the world. If I knew what I know now. Certainly, I'll tell you one thing for sure. If she knew back I know exactly what I'd be doing, and that would not be this. But honestly,
I love it.
This is totally selfish. I'm enjoying it so much. I would do it again, no question.
Okay, well, hopefully we're not going to need a divorce lawyer soon. So
yeah, I will make sure she does not get onto this podcast.
Okay, great. Thank you so much for joining us today, Mahmood and Oliver, and all the best for the future.
Thanks, guys.
For having us.
Thank you.
Thank you.